Let's say you own property, maybe even help your family purchase real estate, and years later you find yourself facing a CRA audit. They say your lifestyle does not match your tax returns, and they calculate unreported income using your net worth, and now you're being reassessed with penalties. That's what happened in Mann versus the King. Hi, I am Amandeep Singh, a CPA and founder of Cloudiverse CPAs. Today, I'll walk you through this fascinating case and share key lessons about CRA audits, net worth methodology, and how to protect yourself. Between 2008 and 2013, Ms. Mann, a former CRA employee and professional accountant, was involved in several property transactions. Some were held in her daughter's names. When the CRA reviewed her situation, they noted discrepancies between her reported income and her financial activity. They launched what's known as a net worth audit, which calculates income based on the change in your assets and liabilities over time. This method is used when standard records are not available or are considered incomplete. Based on that analysis, CRA initially reassessed her for over 5.5 million in unreported income. After internal review, that figure was revised to 473,000 and gross negligence penalties were also levied. Mrs. Mann took the case to tax court, which provided some important clarification for taxpayers and professionals alike. The court agreed that the net worth audit was appropriate in this case because there were significant gaps in the documentation. However, it emphasized that errors or omissions in record keeping don't automatically mean gross negligence. In fact, the judge set aside some of the penalties, especially those tied to misunderstandings around beneficial ownership and plausible financial decisions. It also reinforced that courts are not in place to critique how an audit is conducted, but rather to determine whether the amounts reassessed are accurate and supported by evidence. There are few important takeaways from this. First, the CRA can go back and reassess even old tax years and sometimes beyond the standard limit if they believe there was a misrepresentation caused by carelessness or willful omission. Second, penalties for gross negligence require more than just mistakes. The CRA must demonstrate that a taxpayer either knowingly misreported or showed reckless disregard for the rules. And when the documentation is missing or incomplete, network methodology becomes a tool the CRA may rely on. It's important to know that this method assumes increases in wealth reflect unreported income unless proven otherwise. So, what can we learn from this? Keep your personal and business finances separate. Maintain detailed records, especially when dealing with real estate, family transactions, or joint ownership. If you're helping family members buy property, document the purpose and ownership clearly. If you're ever audited, especially under a net worth review, having those records ready can help clarify your position and reduce reassessment risk. If you've received a CRA audit notice or have questions about how to prepare, we are here to help at Cloudiverse CPAs. Our team supports clients through audits, reviews, and proactive tax planning with clarity and confidence every step of the way. Thanks for watching and subscribe for more insights to protect your business and personal finances. I'll see you in my next video. Bye.